In this lecture, let's look at some of the key stock concepts or market concepts. Every stock has a volatility. So this is calculated as a 12-month standard deviation. So basically what they do is they go back 12 months, look at all the prices and see how much the stock has moved over the past 12 months, and then they arrive at a volatility number. And that means over a period of the past 12 months, this stock has moved plus or minus that number. Let's say the volatility is 20% of Apple. I think it should be close to 20%, but let's just say 20%. And Apple's price is $100 approximately. So which means the standard deviation of that stock is going to be plus or minus 68% of the time. This is a little mathematical. It's not very important, but you should know how this calculation is done. If you recall, standard deviation, one standard deviation represents 68% of the time. So 68% of the time, Apple will trade or is expected to trade between 80 and 120 if its stock price was 100. So that's how they calculate volatility. Let's quickly go and look at the stock volatility. We already spoke about the stock beta. It is the correlation of the stock to the index it belongs in. Now, volume and bid-ask spread are going to become very important in your decisions, because sometimes for some stocks, the bid-ask spread is very wide, and so we call that as liquidity. If a stock is very liquid, then your bid-ask spread is going to be fairly tight. But if you have an illiquid stock, then the bid-ask spread is going to be a lot wider. And of course, volume is important, because the more volume there is on a stock, the tighter the bid-ask spread will be, and therefore you won't have to spend too much on slippage on getting in and getting out of the positions. Now, all stocks belong to sectors, and like we said, it might be in the technology sector, financial sector, and right through the year, money rotates from one sector to the other. And so these are called market cycles or even seasonal cycles. Sometimes some sectors can be hot, sometimes some sectors can be cold. And in the section on ETFs, I'm going to give you a very key strategy. This is going to be your strategy number one, where you're going to be able to identify which sectors are hot, which sectors are cold, and therefore take a much more educated decision on which stocks to buy or which stocks to sell. So that's about sectors. Then you have dividends. Like we said, Apple just issued a dividend of 52 cents. And then we also have some terminology called growth companies and value companies. So in general, you will find that dividends are issued by value companies because they've already gone through the growth cycle. They are matured now. Companies like DuPont, companies like Ford, these are the kinds of companies, well-established old companies that issue dividends, and therefore they are called value companies. Because let's say you bought a Ford share and you've held it for 20 years. Just from the dividends that Ford issues every quarter, your shares might be free right now, because you might have gotten back the entire value you paid for the Ford share from dividends itself. So dividends are a nice way, a stable way to build wealth into your portfolio. Whereas growth companies are the opposite. So if you look at a company like, let's say, one of these, and usually it's a newer company, it's a hot company. So for example, Netflix. Netflix is what you would call a growth company, because its growth prospects, not just in the United States, but also around the world, much of it is yet to be captured. So it's a growth company, and generally growth companies do not issue dividends, even though they are making a profit, because they want to reinvest their money into the business itself. So that's what you would call a growth company. And if you're constructing a portfolio, then you would want to sort of diversify between established companies, growth companies, dividend paying companies, things like that. If you're holding a portfolio of 20, 30, 40 stocks, then you would take into consideration which type of company it is, whether they issue dividends, and which sectors they are in. Shorting a stock is very important. So when you short a stock, you are actually selling first. Okay, so you don't own the stock yet, but you're selling the stock first. If you don't own the stock, how can you short a stock? Well, the way it works is the broker that you're with is going to lend you that stock from some other person. So all this management, the logistics, the broker's platform will handle it. But basically, you borrow a stock from someone and you sell it. And then it is your responsibility to cover it at some point, because you cannot short a stock and just leave it there. Well, if the stock has a good float, which means, how many shares are out in the market, if the stock has good liquidity and a good float, then you can hold a short for quite a long time. But in general, you should be careful, because when you short a stock, you're betting that it's going to go down. And if it goes up, bear in mind you're going to face losses because you've sold it, and at some point you have to buy it back. So if it starts going up rapidly and goes up a lot, you're going to have to buy at the high prices. So it's going to reflect a loss on your account. And besides that, there is no upside limit. So the stock can just rocket up to any level. Now, if you looked at Netflix or Chipotle over the last 3-4 years, it's gone from 2 digits all the way to 600, 700. So if you had shorted one of those stocks at the time when it was $50 and $60, and now it's $700, you can imagine how much losses you're going to face when you have to buy it back, because you do have to buy it back at some point. It's not going to be in a position that you can keep forever. You can keep some of these for a long time, but it's not something that you can keep forever. Now, so why is shorting allowed? Is this something good for the market? And the answer is yes. Shorting is a very important aspect of the market. If you imagine if you were told that house prices can only go up and never down, if that's the case, then it would not make any sense, because at some point all markets get overvalued and they come down. And so when stocks get overvalued, the short come in. So people who want to short the stock, they come in and then they provide this kind of a market equilibrium to the stock itself. So it's a very important balancing mechanism that the market has, and it provides. Only thing is, you have to make sure that whatever stock you're shorting has enough liquidity. So now let's go over to the platform and we'll discuss risk on and risk off modes. Basically, risk on mode is when the stock markets are in a bullish phase. So basically, people are taking risk. So remember, when people are taking risk, they're going to go for the more riskier assets. So that's called the risk on. And when there is some kind of a crisis or geopolitical war or whatever, then it is risk off mode. So what investors will do is sell stocks and get into more stable investments like bonds, corporate bonds perhaps, government bonds, and that's called risk on and risk off. So now, there's various times that you'll see risk on and risk off modes, and we'll be talking about risk on and risk off a lot in the future sections as well. So let's go over to the platform and discuss and see some of these things on the platform itself. So first of all, we want to have a watch list here. And now if you look at the default, you can actually have, many kind of watch lists. So you can say by industry. So these are the S&P sectors. We talked about. You have energy, you have materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication, and utility. Or you can simply look at the NASDAQ 100 stocks and see, you can get a clear view of who are the winners or the gainers for the day. Here you can see the S&P, the markets are down today. So you'll see most of the stocks are in red, but then there are few greens. Let's see, Nvidia is up today. It's up 9% actually. Priceline seems to be up by about 1%. eBay is up by about 1%. And then there are a few other smaller stocks that are up over here. Facebook is down quite a bit. You can see that it's 1.44%. Apple is also down 1.5%. So you can get a view of the market in a visual sense right here. And here you can see the sectors are also the information technology, consumer discretionary, healthcare, consumer staples, and all of that. So let's look at some of the other concepts now. So if you were to buy, let's say you wanted to buy Apple. So let's go here, and if you wanted to buy Apple, you can buy 100 shares of Apple at 96.77. Now, what is 96.77? That's the natural price. So this is the highest price that you're going to pay. But if you look at the mid price is 96.74. Now, also, if you wanted to get actual bid and ask price, you can see that right here. The lowest price is 96.74 and the highest price is 96.75. So the bid ask spread is only 1 cent here on Apple. So that tells you how liquid this instrument is. Liquid meaning how much it's being traded. The bid ask spread is only 1 cent on Apple. You know, that is perfect. That's fantastic. Now let's look at something that is not so liquid. Here, Priceline is a good example. If you look at Priceline, the bid price is 1250.79 and the ask price is 1251.99. So now if you wanted to buy Priceline, you would have to make sure that you try to get in the middle, because you're going to pay almost $1.2 more if you go with the natural price. And so rather than that, you can put your order at the mid price. And what we'll do is, because it's such a high value stock, I'm going to buy 5 shares. Okay, so let's buy at the mid price, confirm and send. And it'll ask you, okay, you want to buy 5 shares. This is the amount, and you can see the buying power effect is 3,000, not 6,000. The cost of the purchase is 6,256. However, my buying power is going to be reduced by only 3,128. And why is that? That's exactly because it's a margin account. And so we only pay 50% of the purchase value. So if I click send, now it got executed, bought 5 Priceline, filled. You can see this message right here. And now if you come to your monitor, you'll see that it is there on your portfolio. So Priceline is on. This is a trade that will keep on. I think Priceline is going to go up more. It reported earnings yesterday. It reported very well. In fact, if you go look at the charts, this is what it is. It reported earnings yesterday, day before yesterday, and boom, look at this gap. This is called a gap. And you know, the stock just rocketed from 1100 all the way to 1229, and today it's at 1250. So now, because it came out with such a good earnings report, you can expect Priceline to perform decently well over at least until the next earnings report, which is going to be 3 months away. So let's say this was on 215 or 216, then until May 2016, you can expect Priceline to behave in somewhat of a bullish way. Now, obviously, its all-time high is much higher. It may or may not go up to there, but you can expect a decently bullish price action from Priceline over the next couple of months or so. So anyway, so now we've bought Priceline. Let's see what else did we miss over here. So I showed you sectors. Now look at Priceline's beta. It's 1.68. So it's a very high beta stock. Today S&P is down, but Priceline is up. And why is that? That's because it's just coming off a great earnings report. So that momentum will carry through. Now this earnings momentum may not carry on indefinitely, but the earnings event has just happened, and therefore it's reasonable to expect that Priceline will have some kind of a momentum that will take it higher over the next few days. And finally, then, you know, that momentum will peter out, and then we'll have to look for new catalysts that will move the stock. Let's go ahead and see if we missed anything else. Shorting a stock. All right, so let's short a stock, and let's go take a look at why would you short a stock. Now, I don't know if anybody's following Chipotle. I've been following Chipotle. Chipotle had very bad news. You can imagine. See, it's got all this E. coli and all kinds of norovirus stuff going on in its food. There was even a criminal investigation that was opened up. So it's been coming down. It came down to $3.99. Now it reported decent earnings, and so that has given it a slight bit of a momentum. But its troubles are not over. So at this point, I feel Chipotle, it might be a good candidate to short, because over the next few days, I feel that Chipotle will come down. So let's see how we short the stock. The Thinkorswim platform also tells you something about the stock itself. Yeah, ETB. If you can see this ETB. So this means it's easy to borrow, and therefore you can short the stock easily. So let's go ahead and short it. So basically all you do is sell. Now remember, we don't have Chipotle in this portfolio. The portfolio started from scratch. Now the only thing we have is Priceline. But I'm going to sell Chipotle. You know, let's say I wanted to sell 10 shares. So I'll change the 100 to 10. and I wanted to sell 10 shares and I wanted to sell it at the mid price. So basically going with the mid price is always a good option. And here you can see this is a limit order. So we'll come to order types on another screen, but basically you want to always put it in as a limit order. So I want to try to get the mid price and I want to sell 10 shares of Chipotle. So let's go ahead, confirm. Now once again I get a credit because I'm selling this. I'll get a credit, but my buying power effect will go down only by half of that. So let's go ahead and click send and see if the order gets filled. It's not filling because, okay, now it got filled. Sometimes if the price that you want is very different from what the stock is trading, then obviously you're going to have to change your orders and reflect a better price. But in this case, we got filled, so that's great. So now we have one long position and one short position. Long in the stock market just means you're bullish. Short just means you're bearish. So I'm bearish on Chipotle, I'm bullish on Priceline. So these two trades are on and we'll continue to monitor them as I prepare this course. Okay, let me show you stock volatility, where it shows. So let's go to analyze. Here you'll see 32.46%. Basically, that is the volatility of Chipotle. Now, this is particular to the options market. It says implied volatility, but basically its standard deviation is going to be around 32%. So 32% of the price. In fact, let's do Apple. It's a much more easier example to understand. Here you can see Apple's volatility is about 26%. So which means, let's say Apple is $100 approximately, then 100 plus or minus $26 is going to be the range for Apple for 68% of the time. Okay, it's only 68% of the time. So the other 32%, it can jump out of the range. So it's all about probability. And as we go further, you'll realize that stock market and probability have a lot of commonalities. And you're going to have to think about stocks or any of your investments from a probabilistic mindset. And that's very important. Let's see, Facebook 33%, Tesla is 57. Tesla and all are very highly volatile stocks. Amazon is also 34%. So that's just to give you a sense of what the volatilities are. Now, I must say that these volatilities are high, and that's because there is some tension in the market. There is some concerns. We are in the middle of Feb. The oil complex, the energy complex rather, has been taking a big crash, and so that's been causing jitters around global markets. Now, just in the last 3-4 days, things seem to have stabilized, but again, now the markets have gone down today, so it remains to be seen. Anyway, so that's as far as stock fundamentals. And as we go along, whenever we touch a concept, we are going to do a trade and we'll monitor that trade and see how it goes. Thanks.